the only free lunch we get as allocators is diversification. And so if I can have, international markets that are decoupling with the US market, that's just a portfolio benefit that's free to us, that there aren't a lot of those around.
We are going to start in a different way than we have in the past. We're going to start with Final Jeopardy. So the category is Friends Reunion Podcast. You each have a card. I want you to write down your answer. So here is the answer. AI, private credit, Bitcoin, Scott Bessent, Warren Buffett's retirement, and kids going to college. Pens down. Okay. We're going to go in order. Brett, you want to hold up your answer?
What Ted lies awake thinking about?
That is incorrect. Meredith.
What are things the friends will be talking about today?
Also incorrect. Jon.
What are the topics this group has discussed and lived through?
Incorrect. Casey.
What is trending up lately?
Also incorrect. So the answer was AI, private credit, Bitcoin, Scott Bessent, Warren Buffett's retirement, and kids going to college. And the correct question was, what are things we did not talk about 2 years ago?
I was the other side of that coin, I think.
It was very close. Lying awake, it was very close.
AI was 100% the other side of that coin. Yeah.
All right, let's jump in on private liquidity. And I think the way to start is to go through each of your situations and privates. Where are you allocated relative to your targets, and what are you seeing in your portfolio on liquidity? Jon, you want to jump in?
Sure. So we've actually, in the last 4 months, have seen a number of liquidity events. We're seeing a lot of the bigger managers buy from the smaller managers. We're probably a little over allocated to privates right now, but feel comfortable to it and are still focused in areas that we've always been, small buyout, defense tech, things like that.
So I'll give a little context on our situation. So as many of you know, we have a lot of real estate exposure, and that is relatively illiquid. In normal times, we get income off of that. Right now, we're actually holding the income back and keeping it there for leasing, for some capital reinvestment that we're doing. So there's no money coming from that. So the 60% of the portfolio that's diversified is providing 100% of our payout. And so we're very focused on what our liquidity is and how much we have in private equity. So our target is 20 to 25%. We were a little over going into year end. We're now a little under. We actually undertook a couple secondary sales in December and January, in the world of better lucky than smart. But that was not a read on the secondary market per se. We did sort of line by line work on those particular secondaries, and we had gotten a decent amount of money from them and felt like the juice looking ahead was just going to be much longer dated and was going to be something like a mid-single digit return for what was still in the ground. So it made more sense to sell them.
How normal of a part of your process is secondary sale?
Very. We will actively use secondary sales, both purchases and sales, to manage. And that is valuation driven, purely. It's not sort of a rebalancing per se.
Case?
So we all obviously have lots of clients that have very customized allocations. We create a private program for them across private equity, real assets, and private credit. And then we model it, updating it every quarter. It's a commitment budget to tell you kind of how much to commit every year, to be thoughtful about diversification around vintage year. We changed it in 2008 because we realized the model that we had used early days at Yale, we were targeting market value as a percentage. And so when you're in a bubble, you actually tells you to kind of over allocate at the top and under allocate when you're in the bottom. So we changed that to grow every client's portfolio by their expected return. And it's helped us not get out over our skis on privates.
Brett?
Yeah, we have been steadily rising our allocations to illiquid asset classes writ large. Each one we're pretty excited about, but pretty niche-y. We don't love private credit overall or real estate per se overall, but there's things within all those asset classes we like a lot, particularly in private equity. Not dissimilar modeling to what Casey mentioned, but given that we have been leaning in and being able to be pretty aggressive with making commitments, so we have not looked at any secondary sales. We did really well in 24 and so far year to date in 25 with realizations. We had well above industry realization activity. So we're seeing slightly below our budget turnover in illiquid portfolios in terms of what we're seeing in distributions, but not much, certainly not what the industry's seen overall.
So across the board, none of you are having any significant excess allocation. The privates don't have to do anything. Are you hearing from peers that people are?
We're hearing it from the GPs because it's taking them longer, to raise the capital. And I also think, touch upon this later, but also I think on the endowment side, with the impending potential tax hike, if you were thinking about wanting to get your allocation down, or you were thinking a lot of monetization events might be more concentrated in the next couple of years, and you have that tax, you're very incentivized to have a secondary sale now, even if you take a little bit of a hit, as long as it's from a break-even perspective better than paying the tax.
But people aren't being forced; they're choosing. There's no downside to exploring the market right now. And so I think a lot of people are looking, but I'm not hearing anybody who's in a forced situation.
So that's a lot different from 08 then, 08, 09.
The market itself, it's been a ride for sure, but at the headline level and over time, the public markets have helped in that regard.
And notwithstanding the endowment headlines, we think a much bigger fund flow that's going to swamp that is the democratization. It's the retail flows. And almost everything we're doing in illiquids is either to get paid to access that, seed things that can take advantage of retail flows, or invest in things that will be sellers into funds that are tapping the retail. And those are much bigger dollars than Ivy League endowments that are over or underweight.
And there's a huge bifurcation going on now because of that. So you have most of that is going into the big funds, the brand names. And then you even see in real estate where the mid-sized funds can't raise capital. And so you have a big gap. So, and a weird inefficiency in the lower end because a lot of institutional capital now can't reach it.
I want to dive into the modeling issue that Casey brought up. How do you model your privates? And you could do kind of a rough question of, if you want $100 in the ground, how much are you targeting to commit over time to get that?
So we've extended the lives on stuff, frankly, in terms of the what we assume it's going to take in terms of getting our money back. And so we've reduced the commitments at the headline level. And so we've brought the headline kind of annual commitment budget down about 20% for that.
And are you doing co-investments in directs? And how's that impacting it?
That's in that annual budget amount.
The more co-invests you do, though, the harder the model gets because you have to assume a sale of that co-invest, and it removes itself completely. Unlike a private equity fund where you're calling down over time and you're distributing over time, it's not this happens in real estate more commonly when they're selling like their whole portfolio, but the co-invests are a little bit harder to model.
Yeah, we think of co-invest like a manager because the co-invest portfolio is diversified in and of itself, and the pacing of that is pretty consistent as it relates to call activity. The more call activity there is, generally speaking, the more co-investment activity we see. We've done the same thing Meredith has, where we're expecting distributions to be a little slower. As I said, they've been a little slower, but not a lot slower. More tail end NAV, more performance front loaded. I feel like we're seeing more NAV markups sooner. And after a few years, you don't tend to see the same amount of NAV markups. And we model the percent of the total portfolio using an assumed portfolio return for the portfolio to grow, right? Because not only are you seeing money come in and out, you're seeing your NAV of your illiquids change, and you're seeing the total value of your portfolio change. So you just have to put all those in. It's not the world's most complicated model, but you just got to be thoughtful about it and tweak it as the world changes.
Any other big changes in your modeling? Meredith mentioned a pretty significant reduction in commitments because of the duration of assets. Any other thoughts? John, anything you guys are doing?
Nothing significant. I mean, I think it's really on the co-investments and directs, and just the impact there, because they can act like a portfolio, but it seems to be a lot more correlated. The sales happen together. deal flow happens together. So you just got to sort of tweak and look at the impact there.
What is the status of late stage growth venture privates as a sort of component of your venture portfolios, with all these larger companies as Stripe and Databricks staying private for longer? Mer?
I don't think the valuations have adjusted enough personally. And I don't, the whole category writ large, so not specific companies, it's like 1,000 overpriced unicorns out there. Like there's going to be, no one's going to make it through the door. And not no one, but not everyone is going to make it through the door. And so we've ended up skewing more to early stage, in all honesty, because the math is just a lot easier. Early seed stuff that in my kind of longer span of history, I would have stayed away from, in all honesty.
Well, how do you think about the dynamic of power law distribution, where if the winners keep winning, and you may be skewing new commitments to the earliest stages, but you may have a lot of those legacy winners dominating your venture allocation?
Yeah. And so that's to the secondary piece, is sort of staying on top of what's the valuation in the market. And then we spend a lot more time for our managers who do cover more of the waterfront in venture and all the way to late stage, understanding what their historical accuracy has been at putting more money into the stuff that has ended up being the winners.
So as you look at your venture portfolio today, how much of it is in profitable, fast-growing, existing businesses that have succeeded through the rounds of venture?
Well, so remember, we started from scratch in 2017. Now, we did a big kind of continuation vehicle / secondary purchase in early 2019. So we have some, though a lot of that has been realized, in all honesty. So like right now, the growth piece of it is probably smaller than most of you guys.
We do a lot in the cash flowing growth equity as new investments, not venture. It's always nice when a venture investment turns into one of those companies, but doing a lot starting there, just a strong belief that the public markets are going to continue to get smaller. There's just a lot of disadvantages with being a public company. It's a nature of the beast. There will be fewer public companies. Therefore, private companies will stay private longer, if not forever. And we're okay with longer holds. Like, we're very focused on multiple, not IRR. And so if we end up owning a good cash flowing, profitable, growing business for longer, that's fine. We also have done more and more, especially recently, earlier stage VC, not a lot of mid-late VC. I worry about the valuations, but we have not seen markdowns, and we have seen realizations at and above marks for the most part. So it feels like there's nothing to see here yet.
We've always leaned early stage. That seemed like the best risk reward. We also just don't love, in general, strategies where you have to rely on the public equity markets. And we tell our clients, and we do a lot of what we call it bootstrap growth equity, which isn't venture, but really a lot of family-owned businesses. And I tell my clients, at a certain size of wealth, and I truly believe this, I view what we're doing, not all privates, but what we're doing in the private space, as inherently less risky than the public markets. Because if we can stay smaller, back groups that have depth on the operational side and the financial side, you're actually adding real value, creating real value in those companies. And then you can use the multiple arbitrage of like buying at low valuations, build it up, and then sell it again to these huge pools of capital that exist today.
And it also reduces the volatility,
yes,
which is an added benefit. But I think that there's going to be some good opportunities. The one question is the continuation funds. As we continue to see the development of those, what's that going to do on the liquidity side? And so I think that trying to figure out what your options are between the secondary market and the continuation funds has really changed the whole game, because you look at these pools of capital that are being raised by some of the larger firms, they got to put it to work. And so I think that you're going to start seeing everything out there for sale.
I think on that point, it's really interesting how many different, we were talking about this with our team the other day, there's just so many more players with different costs of capital in privates today than there has been since we started in the business. And that's going to create a lot of different I think, dynamics you're seeing.
Sometimes within the same firm.
Yes.
Can I ask
No conflict.
at all? Can I ask a related question on the exposure to kind of late stagey growth, profitable companies? Thoughts on getting that through a big traditional venture capital firm, or what started as a venture capital firm and perhaps has become big in sort of these late stage growth companies, or hybrid hedge fund who has a side vehicle where they're doing this stuff?
None of the above.
Neither.
Exactly.
Yeah,
None of the above.
No thoughts?
No, thoughts are, I want someone, no, the thoughts are, we have not generally done any venture capital funds who have gotten larger and merged into growth equity funds. And they're obviously the well-known hedge funds that have launched, big growth equity, private equity funds. Yeah. We've done neither. It has been much more private equity investors who have been focused on, as Casey highlighted, operational improvement, who have been thoughtful about investing in growth industries and or growth companies. And they might pay a modest premium for that growth, but you can grow into a multiple really fast, especially in a smaller mid-sized company where EBITDA is growing a lot. But so it's folks with a really private equity background, not a venture or a hedge fund background.
Growth.
All-time growth.
Yeah.
There's a premise that all of you had on your private liquidity that you're going to just sell to the bigger guy. And Brett, you mentioned the flood of capital from democratization of finance, private wealth. What are you seeing happening?
We're seeing exactly that happening. 25 years ago, if we had a private equity investment that got sold to another private equity fund, there was a lot of eye rolling and frustration. Now that's the preferred exit, and it's the predominance of the exits. Unequivocally, it's happening.
What are you seeing on the wealth interest of that fund flow?
In terms of allocation?
Going into the platforms?
I think it's very high. A lot of it comes from the wirehouses. They are all going from, and you look at some of the big rolled up, independent RIAs. I'm seeing numbers like, we're moving from 5% privates to 8% privates. I mean, these are giant pools of capital that are in the very early innings of having meaningful private equity allocations, nowhere near where the endowments are. And as I said, the pools are much bigger, and they're higher fee products. And you also see firms like BlackRock getting much more aggressive in illiquids and trying to distribute those products, right? So it's not just the brand name private equity firms doing it.
What we've seen from the wirehouses is it's almost more transactional. It's an individual name, it's a brand name, it's easy to distribute, there's lots of fees on top of it. Again, I think the cost of capital they're targeting is lower, so it makes sense to go with those big guys. And I would just say we're just seeing that with our managers, the number one group they're selling to is other sponsors. But what's nice about that size, if your only exit because of your size is public markets, that's inherently tied to your global equity portfolio.
I would say we worry about markets on those exits because if you're exiting to other sponsors, you still need the credit markets to be open and lively. But given the fund flows you've seen to private credit, it's really attractive to those private credit markets stay open more than they used to because there's so much source of private credit versus public credit and even a blurring of the lines on what's public and what's private. But the credit markets being open is still really important to selling to one of these larger private equity firms.
So to date, the money from private wealth has been disproportionate to private credit relative to private equity. How would that shut off?
Taxes are a real problem, but you don't worry about it when you see a high top line return number. Oh boy, I'm getting 12. Isn't that really interesting? But when you're getting 6 and you start writing those tax checks a year or two later, it takes a little while for that portfolio to ramp. Not till it's ramped, you start getting those distributions, and then those K1s come later. I think folks are really starting to wake up to what the after tax is, especially these on-the-run credit strategies.
So in that interval fund structure, do you think that then slows down because of the tax implications?
I do think it slows down, but I think it does continue to grow. It really just depends on the after-tax yield. I mean, so for us, we've seeded some interval funds and some private credit BDCs, because if I can turn a high single digit, low double digit into a high double digit return, I'll pay tax on that and be really excited about it. And so we're expecting to see those flows. And if you can back a really high quality manager who has the ability to sell through wirehouses, but for lots of different reasons needs to be seeded to get up and running. We've done that 3 times in the last several months. We like that opportunity set a lot.
And I think that there's still a ton of capital out there that has FOMO. I mean, people are coming in late. You talk to a lot of these places, and they're going, yeah, look at this area. People have done well. Everybody I talk to has done well in it, and they're jumping in. So I think that it will slow down the pace, but it will continue to grow.
I would just add one piece. I think, again, to bifurcate, we're doing a lot of very niche-y, very senior hard asset private credit stuff where the collateral is very much there. I think one of the things, again, about the retail area and the interval funds is it's a lot of cash flow lending, and it's levered. And that's inherently tied to equity because it's tied to how the business is doing. And so that collateral, you get into a recession, you get into a drawdown period, and that collateral goes away. And we haven't actually experienced that yet. So I think that could be something, if things don't go well as we continue to move through, that could impact flows slowing down to that space.
You go back to B REIT and S REIT. I mean, you had a serious liquidity issue there, which got fixed very quickly. And so I think that people look at that and go, oh, well, it's not a problem. It's like the discussions we had back in 2008 when people go, yeah, I have quarterly liquidity. So, no, you actually don't. And I don't think that people have realized that yet.
Pulling on the thread of the tax implications of credit, there's this possibility of the endowment tax growing up. And I'm curious to hear, because most of you, I'm not sure about Meredith, have managed both tax-exempt and taxable pools. How would you recommend if people are calling and saying, I now have a 20% tax, I didn't used to have that? What changes in the decisions that get made for taxable investor from a formerly tax-exempt investor?
I think everything we do is, and we being all of us, is think about risk-adjusted returns. But those returns have to be tax adjusted. And so there are certain flows of returns that are more tax efficient than others. I mean, I don't mean to gloss over it. It's a different mindset in terms of how you calculate the return profile. But it's not a different mindset in terms of how you think about allocating among different relative opportunities. You just have to tax adjust it.
And when you look at side by side, taxable investor, tax exempt investor, what are the big differences in the asset allocation or the investment strategies that you pursue for a tax exempt investor because of the tax inefficiency for a taxable investor?
I think the biggest ones are not in illiquids, because if you look at endowments where this is where the issue is, they've actually been pretty tax efficient, right? The big Ivy League endowments haven't been huge private credit owners. They've done a lot of growth equity and VC. It's actually pretty tax efficient. And they've done a lot of public equity that's not been high turnover. I think the places where you're going to see bigger hits are on the multi-manager pod hedge funds, which are incredibly tax inefficient, but have been a good source of risk-adjusted returns for some of the larger, tax-exempt allocators. That's where I think the bigger difference is going to be if those allocators are in a foundation where taxes are going to be, or an endowment where taxes are going to matter.
John, anything else?
We've always joked about, you talk to managers who manage their offshore and onshore funds identically. And so many people have not looked at taxes, don't pay attention to taxes. And I think especially retail investors, there was a manager who had a position that had a run up. It was less than 12 months. They held on to it. It collapsed before the 12-month mark. He asked them why. They said, well, we were looking at taxes. He said, well, why didn't you sell it in the offshore? And they're like, oh, I didn't even think about that. And this was a sophisticated manager. Or you ask families, who have hedge fund exposure, you say, well, how many of them have taken the 475 election? I just talked to a manager who didn't even know what the 475 election was, and they had taken it. I mean, I think at the end of the day, when we talk about behavior, if you're being paid, the incentive off of your gross return, that's what you're going to focus on.
So for those who have 475 blank stares, why don't you explain what it is?
Basically, it allows you to get around the wash sale rule. And so every year on December 31st, your whole portfolio is marked to market. So therefore, you cannot have any long-term or you can't have any unrealized. And so everything is short-term realized.
It's actually all ordinary income, which is even worse because you can't take losses to offset it.
Everyone generally is quiet these days about public equities. So all this talk about privates. What are you thinking about active versus passive?
On the U.S. equity side, we've taken just honestly a more conservative approach that we just want to be in like larger cap stocks now, even though that was where you should have been, but more just because it's such an uncertain world and there's all these paths that we could be taking. I just would rather be kind of there and having the active, but still actually active managers today, because we always say, you know, being passive, you're still active. You're actively choosing because it's so concentrated to own those securities. I think in the non-U.S. markets, we continue to find compelling value from being active as well in more concentrated positions. I think the only big shift in our world is really the rise of ETFs, which frankly, we're happy when our managers decide they want to do an ETF because they're fantastic vehicles for taxable clients. And so that's been a huge area that's actually helping us. So we'll have the exact same manager we had before, but because they're in an ETF, you know, it's helpful to the clients from that perspective.
I think you're seeing on some of the more sort of long only, but disguised as hedge funds, that the fees are coming down. I think that, you know, with returns coming down, people are starting to push back. You're seeing a lot more 0 and 30, more alignment where you're not going to be able to get away with the 1.5 or 2 on the long only.
Yeah, I would say, you know, in general, we've focused much more on what bets we're making away from the benchmark, just to be very, very clear and confident that those are bets we want to make. And in some cases, we've taken certain bets off, or we've taken them down a bit. And so we have a bit more of, like Casey, sort of large cap U.S. type exposure. I think we are potentially on the verge of a lot more dispersion globally, a lot more dispersion in markets. And so I think there's an opportunity for the things in the US that haven't done as well from a small cap basis and certain more value looking things. But I think there's an interesting case to be made for EM right now in terms of, EM really runs when commodities run. And I think we could potentially be in the early stages of commodities being very, just the demand being high for them.
Meredith, 2 years ago, you hinted at being interested in Africa.
Africa up about 30% this year so far. And we are in that manager, thankfully.
So what's the case that has you continue to be excited about African equities?
I mean, look, the original case for that was just value and no one was looking at it. And there was just a total dearth of capital there. I do think looking forward, Africa tends to do quite well when the commodity cycle is strong. And that's just, they benefit. I think that there's an argument to be made that it is an easier China play than China itself.
There's an argument to be
So I think there are a couple things that could benefit it, and you haven't seen a ton of capital flow in yet, for sure. So I think you're starting from a low base.
Brad, any thoughts?
Unfortunately, I feel a little like consensus because I agree with a lot of what's been said. If everyone else is different and I'm just agreeing with all these smart people, it's okay. We are passive in U.S. large cap. That has worked out really, really well. We have been reducing that exposure. We've been overweight non-U.S., all active. That's actually worked out well too, especially this year. I mean, they didn't work out well at the same time. We're also reducing that a little bit, but not nearly as much. And we have not done Africa. We have a different view on frontier markets and what the risk return is and liquidity and all the rules. Sure. Just, you're taking a lot of risk and you don't know about repatriation of currencies, liquidity of the markets. And at the end of the day, it's fund flows that drive a lot of those returns. Now, I think there are good fund, right? Basic commodities have done really well this year. That's really good for emerging markets, particularly emerging market countries that are both, central banks are easing and they're big exporters of basic commodities. But for us, that's a cyclical play, not a long-term hold. And I worry about what the long-term risks are in a lot of these countries. And so if we could do it tactically, but it's hard to do tactically given the liquidity in those markets. And most of the managers tend to be believers, not tactical traders of those markets. But there are things like Korea that we've liked a lot, value ups for real, and it's working great this year. And we've been leaning into that, and in Japan and obviously not emerging markets, but there are places you can be outside the US that have been phenomenal this year. But I think the biggest opportunity, both alpha and relative valuations in US small cap. I'd agree with that.
So, Brett, that sounds pretty compelling. Anyone want to poke and prod on that thesis?
Everything's interesting at a price.
Yeah, well, that's
and so that sort of, and I agree with you. You do have to be very on top of kind of what the situation looks like on what you hold, and be willing to rebalance when it's run, for sure.
Yeah, we agree. I mean, we're on the same page as Meredith in terms of emerging markets, and I think a next level too, which I think she alluded to, is you have to be disciplined about kind of selling high and buying low, right? The basic core. So I think you just have to be really careful about when things are running up, when they're, because it is true, emerging markets tied to commodities, that tends to run faster, and just being disciplined with your, I always say we made a lot of money in the early days in the mid 90s, early 2000s, playing off the volatility of our managers. And so the one nice thing about global equities is, again, we're long-term investors, but you can trim on the margin, add to your other managers. Things are kind of running up or coming down. And I think this is one of those markets, even managers actively saying, I'm going to look at things that aren't tied to tariffs. Well, then that all gets bid up. And so, and there has to, you have to have some sort of mechanism to be disciplined about it.
Well, how do you guys think about premium? Like what type of return expectation do you think people should be looking for or accepting?
I think I'm going to give you the terrible answer, which is it depends, right? In something like small cap, I want a real premium, which you're getting today in valuation, and I want a very high expected alpha, and I want that alpha to come from fundamental research that is picking winners that we can then hold for a while, that are going to be long-term winners. So I want to get paid that premium two ways in a buy and hold. If we're going to trade or have a manager who's involved in commodities or emerging markets, I want them to think like a trader. And we have been able to find managers that upside downside capture is really skewed because they're really good at those markets. And so I'm not thinking as much about entrant, what is the premium I'm getting to buy that, and more of the how much volatility is there, and can we capture that volatility versus just be penalized by that volatility.
I think you hit on this key thing that, it's rare when alpha and beta line up. And I think alpha you've always had to some degree in the non-US markets because they're inefficient. That's why we've always liked them. But you now have the beta, you have the valuation piece. And so if you can get those two pieces, like Brett said, together, I think it's compelling.
I think the betas are more interesting than they've been in 15 or 20 years because of not just the entry point, but because of the deglobalization, and you've got a declining correlation of those markets. And the only free lunch we get as allocators is diversification. And so if I can have, international markets that are decoupling with the US market, that's just a portfolio benefit that's free to us, that there aren't a lot of those around.
Sorry, Ted, you asked the questions.
No. Hell no.
I felt him staring at me.
I was waiting for you.
Yeah. And so next, Brad, how do you think?
You're very good at this, Jon.
What are you guys excited about?
I'm excited. It's my anniversary today. I just want to get that out there. Thank you. Shout out to Natalie.
Yay, Natalie.
Yes.
Thank you.
Without her, where would we be?
Nowhere.
I'm excited my baby's graduating from high school tomorrow.
Oh my gosh.
Speaking of
boy.
kids
And
going to
mine
college.
graduated last week. So.
Oh my gosh.
Yes.
Yes. So what I'm hopefully looking forward to, and I hesitate to put this out into the world because it feels like that might not happen, but that diversification, the free lunch on diversification might come back for because it hasn't been that way for, it felt like a long time. And you had to have the bet to truly kind of keep up. And that was, I'm happy to underperform when the markets are running if we can protect on the downside, but to year after year feel like you can't keep up is a lot. And so, that's what I'm looking forward to and happy about.
My new BBR pen is one thing I'm very excited about. So, yes. And where's the camera? So, I'll take NIL dollars for that. Areas that we're looking at are, as you know, we do a lot in the defense tech space. Obviously, drones continue to be. I think it's a lot more difficult than nine and a half years ago when we first got in. A lot of players, figuring out how to manufacture cheap, inexpensive drones is one area within there. We're spending time on nuclear, trying to figure out picks and shovels. So things like standard nuclear, supplying the fuel. We think that trend is one to stay. And if we can sort of figure out the tailwinds, try and take advantage of that.
Dave?
I'm actually really excited about real estate, both on the equity and credit side. I think if you take away all the macro noise, the tariff noise, geopolitical war, real estate, acquisitions in real estate can still be an area kind of just from that. And I think disconnected from that. I think a lot of people forget, like 2022 when rates were high, they've come down, they've not come down enough. So not a lot of capital structures don't work. And these maturities we forgot about the wall of maturities coming due. So we're seeing groups buying things very small, one-off, like self-storage, for example, and then rolling it up all into a portfolio and handing it to everyone who's running interval funds and other things for purchase. So you're seeing a lot more price realization, things coming to market, and therefore deal activity. So if you're a veteran and you've been in the industry through multiple cycles, I think you have the conviction to move forward faster. And I think sourcing is key in this situation because you want to be that phone call with the broker, even at the small end, who's like, I got to move this quickly. These guys need liquidity. Can you do it? And so I think having people who've been through multiple market cycles and understand that and have the deep relationships from a sourcing have a huge advantage.
Are there particular subsectors other than
we're doing it in multifamily, we're doing it in self-storage, we're doing it industrial. So we're seeing it kind of across the board. And I'll stop talking. But the other area we were finding is just niche real assets. For example, we're doing a thing on container ships, which is ones that are a lot of them are not coming to the U.S. It's within non-U.S. ports. And your downside is scrap metal, which is actually pretty compelling. And your upside is huge because if you think trades. So there's just a lot of niche opportunities we're finding that are really compelling in this marketplace.
Yeah, I'd agree with a lot of what's been said. On the real estate side, I completely agree. Public, private credit, the nichier areas, in addition to the ones Casey mentioned, we're spending a lot of time and have done work and have made some investments, industrial outdoor storage, RV parks, all kinds of things like that. On the infrastructure side, rail cars, barges, been really interesting for us. One of the places, though, where we see public, private, and credit incredibly dislocated, unloved, and where we think there's huge opportunity is biotech. It was such a bubble through the pandemic where biotech and vaccines were going to solve everything. And now we've had a massive dearth of capital for years. The public markets cratered in 22 and have yet to meaningfully bounce. The capital markets, except for brief windows, have not been open. No one's reallocating to venture capital funds. It's incredibly unloved. You've got an FDA that doesn't think vaccines should be around. Drug development has really gone sideways. And then you've got a massive decrease in investment in basic science here in the United States. And so you got to be able to look outside the U.S. The story's terrible, but we think it's going to climb that wall of woe. And back to entry point, you've got companies with great management teams, great science, cash on the balance sheet, and trading at massive discounts to cash, or are desperate for money, and you can structure private credit transactions that are really equity transactions, right? These are pre-revenue companies, but where you've got massive seniority and wonderful preferred returns and really neat structures. And so you can buy that through public companies, VC, private equity, and private credit. There's all kinds of things you can be doing in biotech today.
Right. Casey mentioned the two letters that everyone talks about these days, AI. Thoughts on how are you using AI in your investment processes?
Right now, it's early innings, and most of the stuff we've either been able to do or is in our roadmap to do, I would say, are more efficiency enhancements. First drafts of investment committee memos, sorting of presentations, creating analysis of return streams. That's stuff that a junior mid-level professional does, and it takes them time and it makes them more efficient. That's where we are today. I think we're a little ways away, but I'm much more optimistic that we're going to be able to do things. I mean, I think what GA is doing is really cool in terms of having an AI bot on their investment committee, thinking about investment decisions they made in the past and having that institutional memory in a bot. I don't think we'll get there, if ever. But things like triaging managers, understanding what our preferences are, and to be able to make those kind of initial spend more time, not spend time decisions. The other place that I am really optimistic are things that are time consuming but thoughtful, like rebalancing portfolios or flagging things that are out of balance versus, and you can do that through analog software that is just looking at equations and rebalancing, but doing it more thoughtfully, especially when you've got things like taxes and liquidity, which make those rebalancing decisions more complicated. I'm really optimistic there.
We just hired a young guy who just finished up a project for a major endowment, and just how they do it. So we're in the early innings. I think Brett's point about efficiencies, trying to figure it out. Somebody said if you're over 50, you basically use ChatGPT as an enhanced Google. And I think it's great.
Guilty as charged.
Yeah, 100%. And, I think that it's with some managers that we've been with for 2 decades, trying to figure out how do we take all that, the past letters, the past data, how do we summarize it? How do we figure out biases? How do we hold ourselves accountable? And so I think there's going to be, tremendous opportunities. We'll have to see.
Yeah, we're even earlier than you guys. Remember, I work for a church. We're very, very 300-year-old plus, very slow. But I am extremely positive about the opportunities. I remember at one point in like 2000, 2001, a manager we were meeting with was like, it's not the internet. Like the internet is just a means to what is going to come. And it's just a means to what is going to come that's going to be so much more efficient. And ultimately, I think, get so embedded in everything that everyone does that it's hard to imagine right now exactly how it actually plays out economically.
We created a committee. I found after talks with people at varying age levels, we were hitting some roadblocks, and we were really focused on starting bottoms up, like what are one-off things we can do. And so we created a committee within our wealth platform that was, let's just say, made up of within each subvertical, probably the most recent grads. And we had them kind of do work on how they're using it, because we knew that people are using it more than we even realize, right? And so we wanted to both have a way to say, give guidance, like you shouldn't be using it in that way, or you should, but also learn, because our brains can't possibly come up with the things they're coming up with from a flexibility standpoint. So that has been amazing, and they've really taught us new ways to think about it, and then we've been able to mentor them on certain things that shouldn't go into the models or shouldn't go into AI, or that you have to check it. It hallucinates. Like once you come out, it's really important, and that it's most powerful we found when we use our own data, when we're putting in our own information and asking for things kind of on top of that. And then separately, I would just say, I think it's important, like our CEO, Peter Orzak, this has been like a huge initiative across the firm, just thinking about AI and how it integrates across. So they're doing a lot of cross-functional contests, and they have groups present proposals and then sharing that information. And then lastly, I think with AI, the most important thing is data architecture. Because I think, as we've been talking about, even in our world, what software we use, and are we going to, putting on a new software like a performance thing is a big exercise. What's most important actually is your data and your data architecture, because the switching costs are going to be going down, down, and down. So focus more on that aspect of it, and then come up with ideas how to use it.
I agree completely. We have spent so much time the last several years on data, right? And it goes back to, well, one, we've got some regulatory constraints. Like we can't use ChatGPT in the office, right? And there's a lot of LLM we're not allowed to use, right? And so the key is, what can you learn on your own data? But you can only learn off of 25 years of our data if your data is organized really, really well. And there's a lot of advantages to that. Part of it's switching vendors, but a lot of it is being able to train models on our own decision making and our own portfolios.
What are some of the best practices or best use cases you've seen at managers with AI?
I don't know that I've heard one yet.
The best ones I've seen
the one you brought up.
are things like, and Casey does more of this than we do, but lending against hard assets. A lot of that is more smaller balance loans. There's a lot of underwriting to that. The underwriting process often takes a person analyzing. You might have software that scores something first, but if that score can be, a LLM that is looking at your data and outcomes and learning, it will do that better than you.
Nothing else, though?
Time efficiency, I think so.
That's similar. Okay. Compared to 25 years ago when we started doing this, you're all in more senior leadership seats than you were 5 or 10 or 15 years ago. And I'd love to hear how you think about leading a team differently now from how you did in the past.
Try to have a lot more patience.
You're not throwing things around the office as much?
Try not to throw things. I think it's, the best lessons are just no two people are the same. I'm going to sound like the old guy, but, in this generation, it's really understanding what motivates different people. I think that, what I found is that, it's network. You talk to any 22-year-old and that's all they, want to build. It's like you hear this in interviews, and I'm thinking, don't mention network, if you're interviewing someplace. And so it's trying to help them understand. I also have a problem as I look back and I look at a 35-year-old manager. I go, I'd never give them money. They're too young. And then you look at Andreas Halverson, and how old was he when, in '99 when he started? And so it's a little bit of adapting. It's a little bit of perception. It's a little bit of, sort of taking a deep breath and trying to think things through a little bit, in more detail, and understanding that things are more individualistic than sort of a straight management style.
Jon, is there an irony in your telling people not to focus on their network?
Seriously.
Well, I just give my network, so we all share. But good point.
Meredith?
I need to be better at and try to spend more deliberate time thinking about positive feedback. And I'm the kind of person who just sort of puts my head down and does the work. And so I don't care as much about feedback, but I realize that I'm an N of one. And so I need to be more thoughtful about that in terms of the team and thinking about, okay, where are opportunities to elevate the work that someone did in front of more people than just me? And, where can I let this person step up and get positive feedback from me and from others in a more public setting, versus just, assuming we're all going to come and kind of put our heads down and do our work.
I would say there's no better lesson than raising kids, and I'm in teenage land right now, that that people, individuals, human beings are motivated by different things, right? So and that's probably the biggest thing I've learned over the last 25 years. And I think also just having had my own private partnership that was really strong and amazing because we each brought something very unique, both in our knowledge, but also in our vantage points and the way we attack problems. So there's a benefit to having people being different. I think the other piece that we're really focused on right now is, excellence and hiring. We've always hired really smart, capable people, and we have an amazing team with longevity. I think we're increasingly also wanting to make sure that the next person we add, just incrementally every time, is this strive for excellence, and not just excellence in one area like grades, but excellence in other areas, that you've shown resiliency and perseverance and pushing through. And I think if we can find that type of person combined with varying vantage points of the team together, we're just going to come to better answers, because you get much better debate out of that. You get the ability to debate out of that. And I think those things coming together, we're highly focused on right now.
We've always had a management philosophy, or always for most of our history, where the concepts are giving somebody the responsibility for the outcomes and giving them the authority to make those decisions. And those go hand in hand. And then you measure those outcomes. That doesn't mean putting someone on an island. And so what I find I'm spending more and more time on, even though you've given somebody the authority to drive a process that's not you, which is how that evolves as you get bigger, is coaching them to come to decisions on their own faster. It's pattern recognition, right? History doesn't repeat itself, but it rhymes. Like, I've not invested in that particular area before, but it looks a lot like these 3 mistakes we've made in the past. Here are the things we really should worry about before you decide to move forward. And more times than not, that helps them figure out that it's really special because those 3 things that I brought up aren't impacting, or that they actually, listen, yeah, you're right. These are some things I didn't think about. I appreciate that I got to dive into it and I got to say no faster. It's a lot of coaching.
The other piece of that related to that I've found and continue to work on kind of developing the skill, because I find it is much more effective in that regard in terms of the coaching, is instead of telling them like, oh, these 3 things or whatever, like asking the questions so they answer it, because I've found frustration sometimes with when I've told. It's not necessarily
just like parenting, just like what Casey said. You got to let them figure it out on their own.
Like
nothing.
ask the question that helps them own it.
Yes.
Yeah, it's really one of the things we've been talking about is how do we help sort of the younger people in the office learn to listen. And we have all the sayings, listen to understand, don't listen to respond. You have 2 ears, 1 mouth, use them proportionally. Our new one is invert the ratio of question marks to periods. And it's really trying to get them to step back and think about what's the question, what don't they know? And I think that has been something that I've been spending more time trying to help them do. I haven't been fully successful. Again, it's individuals, but I think that's the most important thing. And I think that, especially with these, today, everybody's just taking information. They want it immediately, and they're not stepping back and listening and reading and saying, what questions have I not asked?
We're actually doing sales coaching, and I'm doing it as the leader of the group. I'm like all in on it. But one of the key things they say, because communication's tough at every level: kids, relationships, managers, investing, teams. And they say, people often assume they know what the question is, or if you're telling someone, you don't get any feedback. And so asking questions, which is kind of what we all do for a living with our managers, is one of the key things to getting at making sure you're actually on the same page, which I've also realized, like in so many areas, including work, like sometimes you think you're on the same page and you're not. And that can lead to like a lot of frustration, especially when you're in the leadership position. And so I love like that kind of asking the questions, because you learn like so many more things from that.
The other thing, and this sort of pulls in AI too, because I was talking to someone and they were talking about like, oh, it's going to make it so much easier and we're not going to have to spend so much time training people. I actually totally disagree. Like what we do is an apprenticeship business, and I don't think that AI is going to change that. I think ultimately the most effective are these interpersonal, how do you ask questions? How do you ask a question, hear the answer, and realize what the next question should be from what you heard.
Nuance, right? The nuance piece of it.
What I worry about, though, is I completely agree with the premise, and that's clearly how we all were trained and will be training the people who will ultimately replace us. But if there's fewer junior people, because what we're really using, and I worry about this as a big organization, if what we're really using AI for early is efficiency enhancements, that just means in the future, I'm going to be hiring less junior people because the junior people I have are going to be more efficient. That's going to make their jobs better, and they're going to be able to think more, and I can train them more, but I'm going to have a lot fewer people going into that pipeline. And I just, it puts a premium on hiring the right people, which I hope we do, and I have confidence that we're doing. But we're just going to have a lot fewer people at the entry levels of our industry, and that's going to have some negative ramifications down the road.
Where are they going to go?
Right now, they're just unemployed, right? Recent graduate unemployment's as high as it's ever been. And we can talk about kids going off to college. I'm more worried about my kids leaving college right now.
All of our interns, we have 7 interns this summer, they all are worried that they're not going to have jobs after college.
Appropriately.
So, Casey, that gets back to this question about sales, because as much as all the seats are buying investments, everyone's in the sales business. What have you learned from doing the sales training that we may not have been exposed to?
Yeah. Well, I think just honestly, a lot of people feel like it's inherent. A person is inherently good at sales because they're outgoing, they form connections, there's amazing networking. And I think that's been completely debunked, that there actually is this whole concept of a framework for the initial meeting, a framework for follow-up, a framework for questioning. We have this thing, a pause, in terms of you get a tough question. The one other thing that I learned that is like really helpful for us investment people is it's one of my internal guys calls my head of business development the expert issue, which is someone asks a question and we get this example like gold, for example, and you start saying why you do or do not agree with gold versus trying to first understand why is the client asking you about gold. Gold's a good one, right? Because there's so many different ideas of what people use, and they call it, this sales coach we use calls it, you're focusing on the bridge, which really quickly means you're standing on one side, it's like gloomy, rainy, and gross. You have to walk over a bridge, and on the other side of the bridge is rainbows and puppies. And he said, and you guys are getting stuck in talking about how amazing your bridge is. Your bridge, like we use the best, engineering, we paid top notch, we did this, and this, and our bridge is so much better than the other bridge. And he's like, but nobody actually cares. They just want to walk over the bridge to get to the rainbows and the unicorns. And so teaching the team to stop getting into that bridge unless you're asked to get in that bridge and focus more on understanding what the client's actually trying to ask you.
Goes to listening and understanding.
Exactly. Yeah.
I have a couple of closing questions I'm going to ask. Before we do that, I'm curious if there are any questions or topics you have of each other that you'd like to probe to either learn more or share some insight that you've had of late.
There are 2 that I've been grappling with, so I was trying to figure out which one to do. And I've got my own views on this, but I really want to hear other people's views, and we're kind of, again, spending a lot of time thinking about it. I was actually just in a meeting with our strategists this morning. One is just, what is 60-40 going to look like over the next 5-10 years, right? We talked about, we have a lot of equity exposure in our portfolios. We're trying to be thoughtful about how we get it. Interest rates are at a level that are a lot more interesting than they've been over a lot of our careers, but for a lot of reasons, they may be going higher. I'm not sure that's a prediction. And if higher interest rates mean lower multiples, that's a really bad outcome for 60-40. So I guess my premise is I'm a little worried about traditional portfolio construction. We've been leaning into, and I think we all are with non-traditional. And the other one is the dollar. At the end of the day, we own dollar-denominated assets, or assets where I look at performance converted back to dollars. We think about that as it relates to asset and liability. What's the money for? Asking clients that question. Whatever it's for, it's charity, intergenerational lifestyle that is spent in dollars. So I have to worry about inflation and I have to worry about returns, but I think about it in dollars. And we've really had the exorbitant privilege of the dollar being a reserve currency. Do I have to worry about that or not going forward?
I agree with you. I have concerns about the dollar too. And I try to separate my concerns about the dollar in terms of why I have them.
Right, exactly.
Yeah, so there's that.
Not that it's a good bridge.
Right. Separate from that, I don't know, at least where we sit today, what has the scale to be with the dollar. Like right now, I don't know what, and some people say it's Bitcoin and whatever the case might be. There's nothing right now that even comes close, even if you said it's going to be these 3 things or these 2 things, whatever. And so what my concern about the dollar then is more near term in terms of, it's pretty overvalued. Right. And it's had a run of being overvalued. So, I think it's a fair consideration that you should have diversification away from it. Yep. But that it's still, for all intents and purposes, the major form of currency in our portfolio.
Dollar thoughts, Casey, John?
That's the kind of question mark. I think when Liberation Day was announced, were we all down? We were all down at your Were we down at your summit the night the bond yields started trading off, and I was on with my head of credit, Allison, and I'm like, oh, this is feeling like '08 when the tarp didn't get passed right away in the house, like where things were about to like fall off a cliff.
October 3rd. Yeah.
And so as the bond yields are trading, I'm like, oh my God, who's dumping our debt? And I think that it's interesting, like the dollar, that's the question. And then we always say there's not another one, but there's lots of easy reasons for why they might start dumping our debt, which then cascades into all of these other things. Yeah. So the question I have is, with the democratization and the fees, because you're paying higher fees because in order to administer everything else for that, it costs more. Are those returns and correlations going to be compelling enough to get the diversification that we're able to get with our sized clients by going multi-asset class? Because we have a huge advantage to be able to do that in a big way. And so that's things we're thinking about on the 60/40, like how that
So I always
impacts
come
it.
back to Brett Barth on this, actually. And when I quote if I'm happy with everything in my portfolio, I've done something wrong. And so, like, you can criticize me that I'm being overly flip about this, but I think the way we all manage is we're constantly looking at the 60/40. And is something on the margin changing that and private equity, do we need to extend the years? And so I hope that continues to serve all of us well, and we don't just sort of set it and walk away and think that 60/40 is just what it's going to be forever.
John, thoughts?
Nothing additional to add.
All right. Any other?
I'm just worried because Brett's been very agreeable today. And so that
Something's
is
off.
what is really concerning me. Okay, so
It's his
just
anniversary.
a lot is going through
Part of the
my...
management coaching I've gotten, and as I've gotten older and I've mellowed out.
I mean, we got puppy dogs over here. We got Brett Green. I mean, Meredith, help me here, okay? I'm even a little bullish. I mean, what the hell's happened with this world?
This is very, very strange. On that note, I want to do a quick round of closing questions. So, your favorite newsletter, something you read, something you listen to regularly.
Capital Allocators.
Capital allocators.
Cheers, I know.
And
Capital Allocators Weekly.
No,
Howard
sorry,
Marks still.
Yeah, Howard Marks. I always read Howard Marks. And then the other one, Eric Peters.
There's a great piece that comes out from Jefferies every morning that I read every morning off their sales desk that's really interesting about what's topical today. Because I do try very hard not to be looking at the screen thinking about what's daily, but just being really informed. It used to be reading the front page of the Wall Street Journal. Now you read the front page of the Wall Street Journal, and it's all stuff you learned about yesterday or the day before. They've got a great sell side piece that goes out. And I guess there's some other stuff. There's the guys at Strategis we think are excellent. I really like their stuff. The Washington Research Group at TD Cowen has some great DC stuff that I read all the time. Chris is great. And I love the way he quotes songs.
It's a good point on the manager letters, though. Like, we get so much wonderful data from each of our underlying managers in terms of what's going on. Right?
all right, last one. What's your favorite weekend activity?
We get to have one. I spent the rain in a soccer tournament all weekend.
I'm an empty nester, so whenever the kids are home, whatever I can do with my kids, boating, golfing, watching sports, whatever it is.
And it's just you and Nat?
Whatever Nat wants to do.
I do miss the Saturday afternoon or Saturday morning, Randall's Island soccer games.
I do not miss that. The coldest place on the planet is Randall's Island in April.
Yeah, even in June sometimes.
Seriously.
Just anything with kids. I mean, my son's going off to college, so just trying to enjoy as much time with him when he's willing to talk to me.
Having a good meal, doing a great trip with them. Yeah.
Yeah, just saw Coldplay with my daughter, so that was
Not
a lot of
Taylor
fun.
Swift.
That was 2 years ago. Last year we do our annual concert, so I'm a Tay-Tay fan. Still am.
All right.
Giving up on her.
What are we going to be talking about when we do this next?
Geopolitical impact of geopolitical. I think we got a lot of stuff coming down the pipe. I think that the Middle East. This past week is a major reshuffling that is going to have impacts globally. We're going to be going into midterms. I think you got a lot there. And I'm very concerned about college campuses this fall. So I think that, geopolitical will be back on the table.
Deficits, we talk about it, but it hasn't mattered to the U.S. and, to our conversation about the dollar and 60/40. And you've got places like Germany and the EU, writ large, where deficit spending is now much more common at a much bigger level than it used to be.
Well, there's all the follow-on effects of that, interest rates and inflation.
Geopolitical is an interesting one because 30 years ago, 20 years ago, a geopolitical event would have massive market implications. And since then, geopolitical events have had less and less and less implications to the market. I feel like the pendulum went from overreacting for geopolitical to now we're really underreacting.
I'm pretty convinced that whatever it is we're talking about, it's not going to be any of that.
100, always. It's always the one thing we're not talking about.
All right, Brett, Meredith, Jon, Casey, thanks. So much fun.
Thank you.
Thank you, Ted.
Great to see you guys.